Now we want to talk about some investment strategies. And I'm going to show a picture here. This is of the Great Gatsby. And I'm not showing this because I think you should follow the investment advice or spending habits of the Great Gatsby, because I want to talk about tonight is the Great Rotation, which is the movement out of bonds into equities. And why I'm showing the Great Gatsby is I think there are some similarities between the Great Gatsby and bond investors. Namely, during the movie, Nick Carraway, I say the book, I haven't seen the movie yet, Nick Carraway says to Great Gatsby, "You can't repeat the past," to which Jay Gatsby responds, "Of course you can." And I think that's what bond investors are doing right now. It didn't, I don't want to ruin the ending if you're going to go see the movie. It didn't end well for the Great Gatsby, and I don't think it's going to end well for bond investors. So let's have a closer look at this. If we look at 2-year bonds, you can see that they peaked in December 1981 at just under 17% and went down to about 24 basis points September last year. It's been a great ride, a party that even the Great Gatsby would be proud of. But let's dissect that a bit, because there are problems where we are with bond yields. If we were to add in inflation, you can see that inflation has also come down since 1981 to about 2%, but it's not as much as bond yields have come down, such that if we take the nominal rate and subtract off the inflation rate to get the real interest rate after inflation, it's actually a negative 1.8%. That means that if you own a bond today, you're not even keeping up with inflation. You're losing purchasing power. And this has implications for bonds and also for other investment vehicles. If we were to plot the investment returns of all investment vehicles on a risk-return basis, we would get what we call an efficient frontier. And it's more or less a linear line. It's showing that if you want a higher return, you got to take more risk. There's no free lunch. If we were to add in that risk-return line where we're showing real returns, real return line where we're showing real returns of 0% and add in all the different investment classes, the first one we would put is cash in the mattress. And you can see it would show in a normal market environment would have a negative real rate. And that makes sense, because if you have money in your pocket or cash under your mattress, you're making no return on it. You know and accept that you're losing purchasing power because of the inflation rate. Next up would be gold. Gold should give you a real return of 0. It is your inflation hedge. Cash in the bank should let you keep up with inflation and give you a small real return. And money markets should give you a bit higher real return, short-term bonds a bit more than that, and et cetera, and mortgages, and then finally you go up the risk curve. And again, the more risk you take, the higher return you should expect. This is what you would expect to see in a normal investment environment. The problem is, given where bond yields are versus inflation, it's effectively moving that real return line up, such that all of the assets in that circle are guaranteed to lose you money unless you have deflation. Except I would make the case for gold, which again is your hedge against inflation, which would move up on that line. So given this environment, it begs the question, why are people invested in these vehicles? And more to the point, when are people going to move from bonds into equities, or what we call the Great Rotation? Now let's look at capital flows to see if this is happening. The blue bars are capital flows into bonds. The red bars are showing capital flows out of equities. And you can see over the last 6 years, money has been flooding into bonds and more or less flooding out of equities. Even last year, when we had those high returns, you can see that you had negative outflows out of equities and positive flows into bonds. Well, why is that? Because there are reasons why you want to hold bonds. One is they're liquid. The other is that we mentioned, I talked about deflation, and if you have deflation, bonds still provide a good return. In fact, in Japan, nominal rates have been pretty well 0 for the last 20 years. And on a real return basis, bonds have actually provided Japanese investors a very good return. The other thing, though, is the financial crisis and recession has been very tough. And investors are worried more about return of capital than return on capital. So they're moving down to the lower end of that risk-return scale. If the economy is starting to improve like we think it is, this is going to give investors more confidence that they can move out on that risk curve and will start to move from bonds into equities. And so far this year, you can see from these bars, we're now starting to see some money flood or move into equities. But you can also see bonds have increased. So we're not seeing the rotation out of bonds yet. In fact, most of that money is probably coming out of cash or money markets. But we believe it's not a question of if, but when, as the economy continues to improve, that investors are going to start to do that. So what do you do to try and protect yourself from that? Well, one thing would be to buy equities. And one of the areas, especially given our view of the U.S. economy, we would be U.S. equities. And you can see from this, you can earn about 2% on a 10-year Canadian bond, whereas a good quality blue chip U.S. stock, you can get a yield about 3.4%, so considerably more. Now, in our main Canadian equity fund, we've always invested in U.S. equities, and we've also invested in U.S. equities in our global funds. But we've now chosen to spin off our U.S. equities and our main Canadian equity fund into a separate fund so that we can now make a concentrated bet and investment in U.S. equities. So U.S. equities, I think, is definitely one way of getting a higher return in this investment market. Some other rotation investments to consider would be bond hedge funds. In our bond fund, we only have short-term bonds. We've chosen to have almost virtually no interest rate risk. But we've now decided to augment that with some bond hedge funds that hedge out all of the interest rate risk and take a more levered bet on credit. It is more volatile. It is moving out more on the risk curve, but we think that's a prudent investment in today's environment. Another thing to consider would be a global bond fund. Not all governments are having the same situation that you have in Europe or in North America. There are a lot of countries around the world that have low debt to GDP, favorable demographics, and higher interest rates, such as Brazil, Korea, Malaysia, Indonesia. You want those in your portfolio. They're not only good investments, but they're a good diversifier for your portfolio. And that's the other thing you need to consider in this environment. And David's going to talk more about this, but diversification is a key. If you're going to move out on that risk curve, diversified. You want to have your risk spread out more because you are taking more risk. So to summarize today, we believe the U.S. economy is improving, and we think the employment market maybe, it's in early days yet, but we see some good signs, and definitely in the housing market. And we think that's going to drive consumer spending and thus U.S. economic growth. Canada, not so much. I mean, the employment market is strong, but we think there are some risks, and definitely the Canadian housing market is going to provide a headwind for economic growth in Canada. Best thing we can say about the Canadian economy is our relationship to the U.S. economy. As far as some risks go, I would say Europe is a piece of work, but it's also a work in progress. And it is still the #1 risk we see out there in the capital markets. China and the U.S. we sort of rate as neutral. There are risks with China, but there is a lot of good growth and good demographic opportunities in China that we think they can manage through that. And U.S. debt issue is a concern, but they have time. They just need to address it sooner rather than later. And then finally, keep your eye on the great rotation. It's, again, as I said before, not a question of if, but when, and you want to be able to manage your risk tolerances as you're moving and rotating out of bonds into other asset classes. With that, I'm going to turn it over to David,